Fed Chair Jay Powell admitting that the Fed did consider pausing the rate hikes in the lead up to the FOMC meeting after the fallout from the banking crisis, but they went ahead and continued on their rate hiking path. Joining us now is Pete Baden. He's Genoa Asset Management Chief Investment Officer, and this week's ETF report brought to you by Invesco QQQ. Pete, it's great to see you. So first, just your reaction to what we heard from Fed Chair Jay Powell and also the reaction that we saw in the bond market this afternoon.
Well, thanks. It's great to be here, and thanks for having me on. My reaction to what Fed Powell did, I think he did the best thing he could. He had to raise rates because he promised us a rate raise, but he also had to walk this fine line between being too harsh and crushing the economy and going too far, and also being too dovish, because if he's too dovish, then all of a sudden people go, wait a minute, what does the Fed know that we don't? And why are they all of a sudden so concerned about what's going on? So I think he walked that line pretty finely. And if you look at how the market reacted, first off, bonds going down is a good thing. If the bond portfolios are going up, then maybe the unrealized losses at the banks won't be as bad. And two, it really didn't get really ugly until Janet Yellen was doing her testimony, and she basically said, we're not really up for more than all of the guaranteeing all the deposits at all the banks. And, then all of a sudden we end up here with some losses and, some nice gains in the bonds.
So given all that, what does it mean for your investment strategy moving forward?
We're still looking at the longer bonds. We've been long the 10-year, and we certainly like that place. We're thinking a little bit, taking a little bit off of the 10-year. We think that there's some potential numbers coming up here that, again, it's not a straight line from here to 2%. There's going to be some rocky roads, and you might see some volatility in that 10-year. So we're moving some stuff back into the 6-month. We still think that's a great place to be. Definitely trying to, moderate our credit exposure going into things like corporate bonds or even some of the mortgage-backed securities. Still think munis are great, but definitely want to be rate dependent on those.
Pete, you got some ETFs for us here for investors out there who are looking for exposure to the Treasury market, looking exposure to fixed income. What do you have, and when would some of these investment opportunities make the most sense?
Well, right now, we're certainly looking at the U10 opportunity out there. It's up nicely today. And if you don't want to necessarily take that kind of a duration risk, then U2 certainly has had a nice movement today also. And then, both of these are only single security ETFs. So you only own the cash bond in the ETF. It's not like you own a section of the curve or something like that. So it's pretty straightforward. When you look at something like T-bill, which is the 3-month US Treasury, then you got a chance to really just have almost like a cash surrogate. It's very stable, really nice yield. And then you can pick up yield going out to X-bill, which is the 6-month, or O-bill, which is the 12-month. So all of those, you can combine them, make a very nice duration play into your portfolio, add some duration by putting U10 in, take some off by switching in U2 instead of U10, and really be able to play rates back and up and down the curve, and also have great liquidity, because these trade are the most liquid fixed income securities going. We recently just hit $1 billion, and we're going to be launching the other 5 in the series on Tuesday. We're going to be listing those with NASDAQ. So we'll have the 3-year, which will be UTRE, the 5-year, which will be UFIV, the 7-year, which will be USVN, the 20-year, which will be UTWY, and then the 30-year, which will be UTHY. So each of those will be coming out here on Tuesday, and we look forward to seeing how folks will be using those to help their portfolios and get liquidity in fixed income.
And Pete, in this environment, what's the biggest downside to that strategy?
In this environment, it's the volatility. You've got chances that inflation rears its ugly head, or Fed changes direction yet again, something like that. But you do have a really nice current yield on these to help mitigate some of that loss. And there's certainly a good place to be if things are really going to get ugly and we're going into a recession. Typically, long bonds do very, very well in that environment because recessions are deflationary. And so therefore, the 10, the 20, and the 30 will go pretty nicely in those, and they have in the past.
All right, Pete Baden, great to have you. Thanks so much.